since the beginning of 2018. And remember, we had a big market in 2017, so you'd have expected flows to really start to gush. What has happened since then is there's been net liquidation. If you just look at ETFs and mutual funds, there's been a liquidation to the tune of $350 billion if you take away share repurchases. Don't count those. Are we in a bubble? I do not believe so. And I am very happy that many people are worrying that we're in a bubble. I experienced the late 90s bubble. And yeah, the value investors out there were really worried. And they think they're going to have their day in the sun again because they did so well during the tech and telecom bust. I don't think that's the case now. I think that the seeds for what we're experiencing now were planted back then. Too much capital chased those opportunities too soon. After too few opportunities, there were too few opportunities, and the technologies weren't right. The costs were way too high. We're at prime time for those 5 platforms now and those 14 technologies. And we've just begun. And they're going to be very disruptive and maybe destructive to a lot of value spaces. Not everyone, but anyone looking at price to book, watch out for that book. It may disappear because of disruptive innovation. Anyone looking at that high dividend yield saying, I got to hold on to the stock. Be suspicious of high dividend yields if that company is in harm's way. And I would say there's about 50% of the S&P 500 in harm's way. When we get to economic indicators, go through some of the indicators that are starting to bear this V shape out. Just one other comment I'd like to make. The dollar is something we're watching very carefully. It has settled down. It hit new lows, at least in recent terms. If you, in historical perspective, it's hardly moved out of its recent trading range. But it was starting to break down from levels over the past year or so. We are on dollar watch. The dollar is a good gauge on confidence in the U.S. economy, and it is also a gauge of whether or not our monetary policy is more inflationary than the monetary policies abroad. And it makes sense because we are somewhat in uncharted waters. After 08-09, we were saying we're in uncharted waters when the U.S. central bank reserves went up to, or the monetary base went up to $4.5 trillion from $850 billion. Now, that did not lead to inflation, as we all know, 10 years later. Now we're going up to $9 trillion. Will that cause inflation, or are we in a spiral like Japan has seen in the last 20 to 30 years? Very hard to say. As I've mentioned before, we don't think we have an inflation problem in the near term, but the more complacent investors become about this, the more I will start to worry. Why don't we? I think we're in a bubble because if you look at equity flows since the beginning of 2018, and remember, we had a big market in 2017, so you'd have expected flows to really start to gush. What has happened since then is there's been net liquidation. If you just look at ETFs and mutual funds, there's been a liquidation to the tune of $350 billion if you take away share repurchases. Don't count those. And if you look at fixed income, there has been a net inflow of roughly $900 billion. So think about that, a $1.2 trillion gap there. I will not believe we are in a bubble, equities that is, until we see that relationship flip. The Fed itself is focused on core PCE. That's the deflator, the inflation rate for consumption. And it has moved up to 3.4%. And I would say it could go to 5%. I thought maybe it would top out at 4%, but there has been a head of steam at work here, and we're seeing rents go up dramatically, and that's influenced by house prices going up, at least how it's measured in the inflation gauges. We've seen oil prices, against our expectations, shoot past $70. Right now, we have too much productivity growth coming from a V-shaped recovery, coming from technologically enabled innovation to see inflation taking off. We also have oil prices still down 30% from where they were roughly this time last year. So that's another deflationary undercurrent tugging at the inflation indicators. The economy's flying, and we're in the sharpest rebound from any recession, according to the National Bureau of Economic Research, the sharpest rebound from the shortest recession and the sharpest recession in post-World War II history. So it would make sense. We're out of the woods for monetary policy to normalize. And in a stealth-like way, it might be doing just that. I was surprised to see that the rate of growth in M2 has dropped from 27% in February to 13.8%. And it's a pretty sharp fall. So the rate of money growth is decelerating quite rapidly. The bond market is signaling there are more deflationary pressures brewing out there, we believe, than most investors appreciate. I've just mentioned the good deflation associated with innovation, but the other side of that is creative destruction and the deflation that will hit companies who have leveraged up to buy back shares, manufacture earnings growth, have not invested enough in getting ready for the new world. And believe me, every sector is going to be transformed. And so they will face significant pricing pressure as their products really go obsolete eventually. And then the cyclical deflation. Well, the bond market seems to say this is what's happening. And if that is true, because most people don't believe 1.5% is a real interest rate, they've been normalizing, I think, in terms of the way multiples have worked out in the market, the equity market. They've been pricing or valuing stocks as though the normalized interest rate is somewhere around 4%. What if it's not? What if it is half of that? That would be huge for secular growth companies. Well, we've been struck that the market never priced in 0.5, 1, or 1.5% interest rates. We think the market never believed interest rates would stay down here. And so it over time, we believe, has used sort of a normalized 3 to 5%. So we don't think that is why the market is correcting here. We do think the speed of the increase in interest rates is scaring people. It became very comfortable in a low interest rate environment, nothing much changing, the Fed has our back and so forth, to become involved with the market. And I think this has shaken a lot of investors up, maybe perhaps. And I would say even in the bond market in particular, we've been in a 40-year bull market in bonds.